My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Cybono Discovery Center. Today is a very important day as we are just a few hours away from the final examination, our paper one. And I know that you guys have been preparing, and today we're just going to revise a few aspects which I believe you guys already know by now. So we're just going to go through a few calculations. So you need a pen, you need a paper, obviously, you need a calculator. And I want to encourage you to use the calculator that you've been using all the time so that you do not take a new calculator to the exam venue. All right. Here are my objectives for today's lesson. We will look at the statement of comprehensive income. We will also look at the correction of net profit after tax. We will touch the statement of financial position, the cash flow statement, and tangible assets. We will also touch just a bit on the analysis and interpretation. You can see that there are some aspects that are within the paper one that I've not touched here. I would want to encourage you that after today's class, please go over those aspects that I would not have touched in today's class. It is very important that before you go and write tomorrow's exam, you should know the structure of the paper that you will be writing. And here is the structure of the paper that we expect. You can get a question that is the calculation of correct net profit after tax and the statement of financial position. And in the statement of financial position, you can either be tested on the full statement of financial position, or it can only be the equity or the assets section of the statement of financial position. So here's one of the versions that can come. But your cash flow statement will obviously be one of the questions, and then your analysis and interpretation of financial statements, and then we should expect auditing and corporate governance. So this would become the first version that can come. That is where you get the calculation of correct net profit after tax and the statement of financial position. Remember that question one is structured in about 4 different ways, and we're going to talk about that in today's class. And then the next option would be the statement of comprehensive income. You can see that your auditing, your analysis, and your cash flow statement, these remain constant. But the ones that will change is your question one. So earlier on, we had the calculation of correct net profit and the statement of financial position. The second one that we're going to talk about now is the statement of comprehensive income, that is your income statement, and the statement of financial position. All right, so you can get your income statement as well as your balance sheet, but you can also be tested on either the equity section or the assets section. So far we have two possibilities. Let me remind you of the first one. The first one was the calculation of correct net profit and the statement of financial position. The second one is the statement of comprehensive income and the statement of financial position, that is either the equity and liability section or the assets section. Concepts are tested in 1 or 2 questions. This is where you can get some of your easy marks. Please ensure that you prepare for your concepts, because you get questions where you can easily pick up some marks. The third option would therefore be the statement of financial position, that is your balance sheet and notes. All right, so this is the third option. This is your third option. Remember, these ones you can see they remain constant. The 3 parts, the cash flow, the analysis, and the auditing together with corporate governance, these remain constant. The one that can vary is your statement of financial position in this case, which is the third option. Remember to show calculations to earn part marks. This is very important. Tomorrow, make sure you open brackets. It is very important that all your calculations are done in the answer book, and you must show all your calculations. The other option would be your statement of comprehensive income and notes. Your statement of comprehensive income and notes. This can be a number of notes, and one of the notes that examiners would love to test, it is your note number 5, it can be your note number 9, together with your statement of comprehensive income. Always total figures in your notes. That is, once you've opened brackets, make sure you close the brackets and you put in the total amount. Don't leave any blank spaces. Please, we are not leaving any blank spaces. We are going to close brackets and we're going to record some information. All right, this will help us to earn some easy marks. All right, so we're going to begin with today's activity. So what we're going to try to do in today's class is to cover all these variables that we were talking about. That is your statement of comprehensive income, your statement of financial position, your calculation of correct net profit, your cash flow statement, and then we'll see if we can bring in different calculations. So please ensure that you have your calculator, that you have somewhere to write, and then we are going to begin with the November 2020 paper. You will see that this paper has a 2 in the bracket. That is the paper that we are going to begin with. All right, so if you're ready, please let's work together. If you feel that I'm too fast, tell me. Okay, Mr. Simbi, you're too fast, then I will slow down. If you feel I need to repeat something, please don't hesitate to tell me, then I will repeat that. Remember, at the end of the day, it is about you getting the best mark possible. And I believe you're going to get that beyond any reason of doubt. Let's begin with the first part. It reads, Robbie Limited. The information relates to Robbie Limited for the financial year ended 28 February 2021. So in the 10 minutes reading time that you'll be given tomorrow, use that time to read the question properly. One of the key aspects of the question is the financial period. Do not assume that it's ending on the 28th of February. It might end in March. It can end in June. It might end in August. So please read the question properly. Read the information properly. And remember, when you read the question paper, you read it together with the answer book so that you can relate with what the examiner wants you to do. And then in 1.3, it says, prepare the statement of comprehensive income for the financial year ended 20 February 2021. And this was for 43 marks. Let's see more information. So the first adjustment that we're going to do, I'm going to be looking at adjustments. I'm going to show you how to do certain adjustments. So what you should be able to do is to see how we are doing it together so that you can also prepare after today's class. In this adjustment, we are told the business maintains a markup of 120% on cost. Note, trade discounts of 648,000 were granted to special customers. So in this activity number 1, we are saying if we get a statement of comprehensive income and you get such adjustments, what would you do? We know that this has to be recorded in your statement of comprehensive income. So we're going to come here and then we're going to say, the first thing we're going to say here, we need our sales. And after our sales, you're going to need your cost of sales. All right. So you see, I have my cost of sales over here. And after that, what then comes? Yes, then you get gross profit. Here you get gross profit. Awesome. You are told here that the business maintains a markup of 120%. You have to know that that markup of 120%, that is your gross profit. So we're coming here to say my gross profit is 120%. All right. And then your cost of sales is always 100. Your cost of sales is 100. So here we have 100%. How much is your sales then? You know already that becomes your 220%. Okay, let's see. What should we calculate? In this information, we are given cost of sales. So our cost of sales should be here already as your 6,966,000. What we need to get is our sales. So I'm going to come here and I'm going to say, what is it that I want? I want sales. What percentage is sales? 220. So I'm coming here to say what I want is 220, and what I have is 100. And what I have in rands is the 6,966,000. Okay, guys, you need to keep your calculators close today. I'm going to be asking you, then you give me the figures such that we can progress together. So in your calculator right now, I want you to punch 220, which is your sales. Then you say divide by 100, multiply that by 6,966,000. How much do you get? All right, thank you. I hear someone saying I get 15 million. Say it again, 15,325,200. Okay, is that what you're getting? All right, thank you. That is 15,325,200. Remember now what they told us, that trade discounts were granted to special customers. That means we're going to come here and we're going to subtract the trade discount of 648,000. Now I want you to say your 15 million that you gave me earlier on, 15,325,200 minus 648,000. How much do you get? Thank you. Someone is saying I get 14,677,200. So remember, we come here, then we subtract what? Our cost of sales. What do we get now? Gross profit. How much is a gross profit? So we are saying the 14,677,200 minus the 6,966,000. How much you end up with? 7,711,200. That becomes your gross profit. But now the examiner can bring this in a different way as well. What if they give us the sales after the trade discount, and then they want you to calculate the cost of sales? You have to add the trade discount back to the sales amount that you'll be having here, so that you come back to the 15 million. Then you calculate your cost of sales from the 15 million. Did you get what I said? All right. The second version is the examiner gives you your sales after the trade discount, and then you must calculate what? Cost of sales. You have to add the trade discount so that you can get the amount before the trade discount. Then you calculate cost of sales from that particular amount. That is how you come back to that amount. Can we move on? All right, thank you. We're going to move on to the next adjustment. And the next adjustment reads, all right, the account of a debtor, B melter 800 must be written off. Once an account is being written off, that simply means we are creating bad debts. Once an account is being written off, that means we are getting bad debts. All right. So that means here we are going to come and we are going to say, remember, this is an expense. So we are coming here to our operating expense. But you have to understand that these bad debts of 800 affect two amounts. They affect two amounts. They affect the 800. It affects two amounts. It affects your income statement. It also affects your balance sheet. If you check in your question paper, you would find that in your balance sheet accounts, you also have debtors control. You also have debtors control. And that debtors control, which you are given in the question paper, is 123,000. You have debtors control of 123,000 in the balance sheet account section. So when you come here on this adjustment, you are now saying you are going to adjust it in the income statement and in the balance sheet as well. In the income statement, you are coming to say, under your operating expenses, you would then say bad debts. Here is your bad debts. And then you open bracket, and then you'd say your 19,200. And then you are now going to say plus the 800. Okay, so your bad debts have increased in this case. Remember to open brackets and to close the bracket, and then you give me your 20,000 over here. But whilst you are at it, you have to know that this bad debts is going to affect your debtors control. So here on your debtors control, it's also going to be minus 800. You're going to see when I do the next adjustment how that 800 is going to affect your debtors control as well. So once you see such an adjustment, remember it affects two, the income statement as well as the balance sheet. Let's move on to the next adjustment. All right, so in the next adjustment, remember I told you about the debtors control. So in our debtors control already, we know we have said already minus 800. So we don't have 123 anymore. We have 123 minus 800. So we have 122,200. Is that what you're getting? Are you also getting the 122,200? Okay, if you're getting the 122,200, that means you've already subtracted the 800. Now we can come to this adjustment. So you cannot do the provision for bad debts adjustment before you have adjusted for the bad debts. Your provision for bad debts amount will be incorrect. That is why even tomorrow you have to do the adjustments in the way the examiner has set them. You cannot do A, then go to C, then go to E. But you have to do A, go to B, go to C, go to D, go to E. Because they are arranged in that order for a reason. So that after the bad debts adjustment, you can now do the provision for bad debts adjustment. Let's do that. So we are told that the provision for bad debts must be adjusted to 5% of outstanding debtors. So our outstanding debtors is how much? How much is our outstanding debtors? Thank you. 122,200. So we come here. We have our 122,200. Then we are now going to adjust it to what? 5%. Multiply by 5%. Quickly on your calculators, please. Quickly on your calculators. How much do you get? 122,200. Multiply that by 5%. How much are you getting? Thank you. 6,000. Repeat that. 6,110. Okay, so you get your 6,110. That is your bad debts amount. Your provision for bad debts amount, rather. Now, when we are recording in the statement of comprehensive income, the easiest way to understand it is that we are recording either an increase or a decrease, whereby an increase is an expense, other operating expenses, and a decrease is income, other income. So we will now say how much was provision for bad debts last year? 7,030. So if last year it was 7,030, this year it is 6,010. 6,110. 6,110. What do you see here? Is it an increase or a decrease? What do you see? Thank you. Someone saying, Mr. Simbi, I see a decrease. It is a decrease of how much? Of 920. So here we have a decrease of 920. The moment we have a decrease, is it income or an expense? It is income. That means I'll come to my other income. Are you following? All right, thank you. So I'll come to my other income. What do I now say now? I say provision for bad debts adjustment. Do you see what I'm doing? That is what you must do tomorrow. Then you come and say 7,030 minus 6,110. All calculations must be shown in brackets. Then you close your bracket. Then you come here, you say 920. Once you do it like that, you are smiling all the way to the bank. Are we good with this adjustment? So provision for bad debts, once you calculate it, you either look for an increase or a decrease. Are we okay? That is how it affects the statement of comprehensive income. But if we're doing the statement of financial position, we would come and then would say to our debtors control, the 122.2, we would say minus. Minus how much? 6,110. So we would subtract it as it is. In the balance sheet, we subtract the entire amount. In the income statement, either an increase or a decrease. Increase, expense. Decrease, income. All right, let's move on to the next one. All right, the next adjustment, here's the next adjustment, and it reads E. The trading stock is valued on the weighted average method. The trading stock is valued on the weighted average method. So I want to encourage you, you cannot go to write paper one without knowing your inventory valuation methods. That is your FIFO, your weighted average, and your specific identification. In today's class, I'm going to touch two of the methods. That is your FIFO and your weighted average. So please stay put because we're going to do those two methods. Okay, in this case, they use the weighted average method. The ledger account and records reflect that 280 units should be on hand. Should be on hand. However, the physical stock count reflects only 262. That means already something is not good here. On hand, the stock records are as follows. There is the stock records. So we should be having 280, but we have 262. What does that mean? If we should be having 280, but we have 262, that therefore means there is some units missing. Do you have your calculator there? All right. If you say 280 minus 262, how much do you get? Thank you. You get 18. So there's 18 units that are missing. But if we're to record it in the statement of comprehensive income, can we come and say trading stock deficit, then we say 18? No, because 18 is the number of units. What do we want? We want the value thereof. And which method are we using? The weighted average. That means you now need to get the value of these 18 units using the weighted average method. Can we do that? Let's go. That simply means we come to our total column here, then we look at the units available for sale. How much are they? 8.1 million. Then we're going to say our 8.1 million, or 8.1 million, then we divide that by the number of units available for sale, which is your 2,000. So 8.1 million divided by 2,000. Make sure tomorrow you punch in the figures properly. 8.1 million. Once you make a mistake with the zeros, it affects everything. So please, I know you guys love punching figures incorrectly. Tomorrow, make sure. Tomorrow, make sure. All right, how much do we then get here? The average price would therefore become how much? Okay, someone is saying, how much are you getting? 4,050. 4,050 becomes the average price per unit. That simply means I'll take now my 4,050. I multiply it by the number of units. How many units are those? 18. Calculators, how much are we getting? Thank you. 72,900. Now we have the rand value of the missing stock. And we know one stock is missing. We call it what? Trading stock deficit. So I'm coming here now to say my trading stock deficit. I want whoever is going to mark my paper to know. I know what I was doing. How many units were they? 18. What was the price per unit? 4,050, the average price per unit. Therefore, my expense is going to be 72,900. That is how you would do it. All right. I'm going to show you when we do the statement of financial position how inventory also affects the statement of financial position. Okay, can we go on? All right, thank you. Let's go. Let's go. The next adjustment then reads, 30% of the audit fees is still outstanding. I know you have seen this adjustment. Do not assume that you know this adjustment from the past. Make sure you read it nicely. Do not be hasty. Once you see, okay, I think I know this adjustment, be calm at that moment. Read the sentence again so that you can clearly understand what the examiner is saying. The examiner is saying 30% of the audit fees is outstanding. It means if we pay audit fees in total, we must pay 100%. That is what we must pay. But so far, we have paid audit fees which are not enough, such that we are still owing 30%. Is still owing. How much have we paid? That means we've paid what? 70% has been paid. So the audit fees that we get here, the 91,000. That therefore becomes the 70%. You have several options now of getting your figures. When you come to your statement of comprehensive income, you are now saying audit fees. Audit fees. Remember what we've always been doing. You open bracket, 91,000. Once it is outstanding, owing, accrued, it means it has not yet been paid. Outstanding. It is owing. It is accrued. It means we are going to add. It means we're going to add. Outstanding, owing, accrued. We must add. So you have several options. Let's start with the first option. How much is owing? What is owing is 30. That's what we want. What do we have? We have 70. Multiply by 91,000. Come on, are you still there? All right, thank you. Punch that in the calculator. How much do we get? So you want the amount that we are still owing, that is your 30. Then if you punch that in the calculator, how much do you get? 39,000. Thank you. 39,000. That means I can come here and say audit fees that are outstanding. Remember, once an amount is outstanding, in the income statement we add it. In the balance sheet, we take it to trade and other payables. It's a liability. Payables, because it is a liability. An expense is still owing. So I'm going to come here and I'm going to now say, remember what we have agreed. Once it is owing, accrued, or outstanding, what do? We add. So I'm going to come here and I'm going to say plus. Plus how much? 39,000. Calculators, please. Calculators. 91 plus 39. How much do we get? Thank you. We get 130,000. This one was an easy one. You could have used another method to get the 130,000 straight. What would you have said? You want what? 100. If you say, I want 100, what do you have? You have 70. Multiply that by the 91,000. How much do you get? Oh, you get 130,000 straight. Are we good? All right. Okay. Next adjustment. It reads, the monthly rent income did not change during the year. All right. So this is a rent adjustment. During February 2021, the tenant paid 9,000 for repairs to the premises and deducted this from his rent for February. Okay. So there was a leak in the roof. Then he decided to repay it. Then he said, the amount of rent that I must pay you as my landlord, I'm going to deduct the amount that I paid for the repairs, which is how much? 9,000. He deducted this from his rent for February 2021. Repairs are the responsibility of the company. That means we must record repairs in our income statement as an expense. They are the responsibility of the company, and this was not recorded. So they're telling us that we must record repairs. We must record what? Repairs. Can I go on? The rent for March 2021 was received in advance. Okay, so we have a couple of problems here. Let's solve the easiest one of them all. The easiest way to solve this is to say, this amount of money that I have been given is for how many months? Remember, the financial year has to end in February. But this guy paid us rent until what? March. So we are dealing with 13 months. But in one of the months, he did not give us the entire rent. It is less by 9,000 because he paid for repairs. Then he said, from the rent that I must pay you, I've deducted that 9,000, which I paid for repair. So that means we have rent for 13 months less 9,000. So this is 13 months less the 9,000. So if we want the complete 13,000, what do? We add the 9,000. That means I'm going to come here. I'm going to say 173,000. 173,000. Are you following? Then I'm going to say plus how much? 9,000. Once I add the 9,000, how much do you get? Thank you. you get 182,000. This is 13 months incomplete now. So you can then divide this by 13. How much you get? Rent per month. Rent per month is 14,000. What was our problem, by the way? We received the rent for March. Were we supposed to receive rent for March? No, this is income received in advance. That means we have to adjust it in the income statement as well as in the balance sheet. In the income statement, income received in advance, we subtract. In the balance sheet, trade and other payables. It is a liability. We owe our tenant because they gave us money in advance. So let's go and record it. In the statement of comprehensive income, other income, we're going to say here, rent income. Here is my rent income. And then I'm going to open my bracket. I'm going to say 173,000. Then what do I say now? That 173, remember, we added 9,000. So I'm going to say plus 9,000. Then we come back to the what? To the 182. You still with me? But this is now rent for 13 months. So I must remove the month paid in advance minus the 14,000. I close the bracket. Remember to close the bracket and always record your amounts. And then we now were told that repairs were not recorded. I must record the repairs. Let's come and I'll say on my repairs, I had 476, but I know that we've done repairs. Okay. And how much was that repairs amount? 9,000. So I'll come in, then I'll say plus 9,000. Okay. Are we good? All right. Thank you. Thank you for the confirmation. We're going to move on to the next adjustment. I think we're going to do another rent adjustment again. So please stay put. We have another rent adjustment. Oh, one of the popular adjustments is the director's fees. If you're worried about the director's fees adjustment, we have one here for you. Let's hear what it is saying. Here it goes. The company has 4 directors. How many? 4 directors. Let's see where the 4 directors are. Here are the 4 directors. Director number 1, number 2, number 3, number 4. How many directors? 4. Are you still there? Let's go. One director resigned on the 31st of May and received his fees up to date. Oh, he resigned in May. When is the financial period starting? The 1st of March. So he worked for March, April, May. So he worked for how many months? 3. Tomorrow, use your fingers. Don't try to use your brain without using your fingers. When you count the months, literally say March, April, May. Use your fingers tomorrow. So this director worked for how many months? 3 months. You still following? Let's go. And he received his fees up to date, so we don't owe him. Another director is still owed fees for January and February. This director number 2, we still owe him fees for January and February. We're supposed to pay him for how many months? 12, but we've paid him for 10 because we owe him 2 months. So we paid him for 10. What about the other 2? They were silent. That means we don't owe them anything. That means we pay them 12 and 12. If we add this, calculators, 3 plus 10 plus 12 plus 12. How much do you get? Thank you. 37. Did you say 37? Okay, thank you. 37. So if the directors have all been paid for 37 months, this 3,330,000 is for 37 months then. You're following me there? So we're going to come here, then we're going to say that 3,330,000, we divide it by 37 months. We want to know how much is director's fees per month, per director, per month, per director. How much do you get? Please, let's punch that in the calculator. How much are you getting? Thank you. You're getting 90,000. What was our problem? This guy here, we paid him for 10 months when we were supposed to pay him for 12. So we owe him for 2 months. How much is that we're owing him? 180. What is it when we are owing? Outstanding, accrued. Okay, so in the income statement, what do? We add. In the balance sheet, what do? Trade and other payables. Let's see if we can. We come here then. What do we say? Director's fees. We say director's fees 3,330,000 plus How much do we owe for the director's fees? 180,000. Are we together? Then we close this. How much you get? 3,500,000 and who? 510,000. Thank you. That becomes your director's fee. Remember, it also goes to the balance sheet. We good? All right. Let's quickly see if there is still more adjustments. We have one more. All right. Let's see. It says, advertising consists of a contract with a newspaper for the entire financial year. Payments are monthly. However, installments were paid for 11 months only. So we paid only for 11 months. Note, the monthly rate decreased by 240 from 1 November. So we are supposed to pay for how many months? For 12 months. Are you still with me? But we are told we have paid for 11 months only. And the payments have decreased from the 1st of November. Remember, the financial year, it begins on the 1st of March 2020. When is it ending? On the 28th of February 2021. But the rate decreased. It went down by 240. From when? From the 1st of November. So from the 1st of November, and then we did not pay for this February as well, because we paid for how many months? 11 months. So there was a decrease from the 1st of November. We start counting. November, December, January. Do we count February? No, because we paid for how many months? 11 months. That means we are owing for the month of February. So the decrease was there for how many months? 3 months. November, December, January. So we would then come and say 3 times, how much was it per month? It was decreasing by 240. So 240 by 3, please, I want to see your calculators. How much do you get? 720. Thank you. Okay, remain on your calculators. So this is the total decrease for these 11 months. So if I take the amount that we have here, that is your 25,680, and then I come and I add the amount that it was decreased by, I should get an amount. How much is it? 26,400. This is the advertising for how many months? For 11 months before any decrease. So I'll divide this by 11. You're still following me? All right. So this is going to give us advertising per month before the decrease. So it's 26.4 divided by 11. Quickly on your calculators, please. How much do you get? Thank you. You get 2,400 per month. But we are told that we paid for 11 months. That means February has not been paid. But February is coming after November, after the decrease. That means in February, we are paying 2,400 minus the decrease. How much is the decrease again? 240. 2,400 minus 240. How much are we paying per month after the decrease? 2,160. We take it to the income statement. What is this now? An accrued expense. We add in the balance sheet, trade and other payables. Trade and other payables. Let's see what the answer book looks like. So we're going to come here, then we're going to say advertising. Please make sure when I'm writing, you're also writing. Okay, advertising, I open my bracket. I'm now saying 25,680. Okay, then we say plus. Plus how much? 2,160. Then how much do we get in total? Thank you, 27,840. That becomes the amount now that appears in the statement of comprehensive income. Okay, so in this adjustment, you had to get the amount before the decrease, and then you come back to the amount after decrease. Okay, we've come to the end of this first paper. All right, so we're going to take a very quick break, only about 2 minutes, a 2-minute break, exactly 2 minutes. Then we're going to come again, and when we come back, we're going to be doing the NSC November 2021. It's going to take exactly 2 minutes, so don't go anywhere. In 2 minutes, we're going to be back again, and we continue. Welcome back, guys. Welcome back. Before the break, remember what we did? We did a statement of comprehensive income together with a statement of financial position. So we covered much ground then. We did some interesting adjustments. But what I have here now, it's going to be the calculation of correct net profit. Yes, we're going to do the calculation of correct net profit. I see most of you are finding new papers to write on. That's good. So we're going to do the calculation of correct net profit together with a statement of financial position. So we're going to do these ones together at the same time. Are you ready? Okay, let's go. The information from the November 2021 paper reads, GMO Limited, the information relates to the financial year ended 30 June, okay? Take note. So this one is ending on 30 June 2021. The business sells formal clothing for men and women. Required 1.1. Refer to information B. Calculate the value of closing stock of formal suits that was omitted from the stock sheets. Okay, so we are seeing now the second inventory valuation method. Remember, in the first one, we did the weighted average. And in the second one, let's see what information we are given. In this one, it says the accountant omitted the closing stock figure of formal suits in the trading stock balance provided in information A. Note, the first in, first out, that is your FIFO method, is used to value the stock. So far we have touched the weighted average, and now we are attending the FIFO method. So tonight you can also look into the specific identification method, just so you may not be found wanting. All right, all other relevant entries have been recorded correctly. Okay, so we are told here that we have to calculate the value of closing stock here, where you see the question mark. If it is your FIFO method, this is easy. Where do you start? You simply look at the value of closing stock there. How many units do we have at the end? It is 240. So that means I'm going to come here, then I say 240. And then that is not a division sign. No. Not a division sign. I'm building here. Okay, can I say it again? Not a division sign. We are not dividing anything. We are building. So we're going to say 240. Then we look at the most recent purchases. Which ones are the most recent purchases? The ones in May. But if we look at the purchases in May, there were returns that were done from those purchases in May. And how many units were returned? 24. That means I'll come to the 230, then I'll say minus 24. You still following? That means I don't have 230 no more. How many do I have now? If I say 230 minus 24, what does your calculator say? Thank you. Your calculator is saying you have 206. So you come here, you have 206. And these units, what is their unit price? Their unit price is 2,850. Calculators, how much do you get? You're saying 206 multiply by 2,850. How much are you getting? 58,000. Oh, 587. Say it again. 587,100. Okay? Are we okay? All right. 587,100. Let's continue. But you need 240. So you then look in the next month. What is the next month? February. How many do you have in February? 170. How many do you need? You say 240 minus 206. How many do you need now? You need 34. 34, and you're getting them from the month of February. The unit price is 2,600. And then you're going to come here, then you say 34, multiply by 2,600. That is going to give you 88,400. Then we add these amounts. If we add these two amounts, 88,400 plus the 587,100, you get 675,500. 675,500. So this is the value of this closing stock. Okay, so in this particular question, they wanted you to calculate it separately, but you have to keep in mind that this affects the balance sheet because you have stock that was omitted. In other words, if we are to continue and we are going to prepare the statement of financial position, we have our value of closing stock. Remember, we've calculated it. we will then come to our current assets, statement of financial position. So we're going to say here, inventory. Inventory. What do we do? Open bracket. How much is it here? 4,198,500. Can I go on? Then we are told that we have stock which was omitted. How much is that stock? Plus 675,500. This is the stock that was omitted. So you come and you add it to your inventory. Are we okay? So we've seen how it affects the income statement, trading stock deficit, trading stock surplus. And we've seen how it affects the balance sheet. If the amount is omitted, you simply come and you add it. Okay, let's go on. The next adjustment that we will see relates to audit fees. So now we are doing the calculation of correct net profit here. The net profit before tax was 4,918,950. Okay, let me just remind you, we are in the NSC November 2021. In the NSC November 2021. And then we are told that this amount was calculated before taking into account or correcting the following. So we need to do some corrections here. Audit fees include 123,600, which was paid in advance. Paid in advance for the next financial year. All right. So what we are having is a prepaid expense. The moment we recorded this prepaid expense, it means we recorded more of our audit fees. We inflated our audit fees. We had more of the audit fees. Remember, audit fees are what? Expenses. Once you have more of the expenses, it decreases your net profit. Are you still with me? So that means when we are correcting this, whereby we recorded more of the audit fees, we have to come here and we say audit fees. Audit fees that we recorded decreased the net profit. But these audit fees were supposed to be for the next year. That means the net profit we have is understated because there are audit fees for the next year that we have recorded. Can I say it again? We have recorded audit fees for the next year. That means our operating expenses are high. Once expenses are high, profit becomes low. How do we correct that then? We need to add back. So we come here, then we say plus how much? 123,600. Are we good? All right. And then we have to remember that we're preparing a statement of financial position. That simply means we have a prepaid expense that is a receivable. So I'm going to come in, then I'm going to say plus 123,600. What is this? A prepaid expense. It is a prepaid expense. We're told paid in advance. A prepaid expense. All right. Can I go on? Thank you. Let's go on. Mortgage loan. I know most of you love this adjustment. Okay. So please make sure you follow me. All right. When I do this adjustment, we have information from 2020 and we have information from 2021. And we are told the net profit before tax, remember we know this now, okay? And then the repayments on the loan are fixed. Very important. Fixed. That word is key in this entire adjustment. The repayments of the loan are fixed at 35,000 per month. They are fixed at 35,000 per month. That is including capitalized interest. What does that mean? It simply means when we are making payments, we are making payments of how much? Of 35,000 per month. How many months are in the year? 12. 35,000 multiplied by 12. I need those calculators. How much do you get? 35,000 multiplied by 12. Thank you. You get 420,000. 420,000. So we are making payments of a total of 420, but it includes interest. That means in this 420, we have two things here. We have interest and we have the loan repayment. Two things, because we are told it includes interest that has been capitalized. So in that 420, there are two amounts. There is the loan as well as the interest. Can I go on? Now, in this adjustment, we are preparing the correct net profit. We're going to do that one first before we go to the statement of financial position. So what we need to do is to calculate our interest expense. Interest expense. I'm going to take you back to grade 10. Let's see what we did in grade 10. In grade 10, we opened what we called the ledger account. All right. So we're going to open a ledger account here. And we call it a loan account. Loan, asset or liability? Liability. That means on the credit side, it increases. On the debit side, it decreases. Am I good? Thank you. Then we're going to take the opening balance. Okay. So how much is the opening balance? The opening balance is 4,175,000. Still the same. So here I have my balance brought down, 4,175,000. Okay. Then interest is being capitalized. Hence, I'm bringing it to the credit side. And then we don't know that interest, but what we know is that we have made repayments here. And those repayments include two things, interest and the loan as well. And those repayments are for 420,000. And then we also have a balance carry down. And the balance carry down is your 4,028,000. 4,028,000. I need calculators now. What do you say? 420 plus the 4,028,000. How much do you get? You get 4 million. Say it again. 4,448,000. Thank you. 4,448,000. 4,448,000. If you take that 4,448,000, then you subtract the 4,175,000. You get interest now. How much is that? You're going to get 273,000. That becomes your interest. Okay, so keep that in mind because we're going to record these amounts. All right, so when we come here, we are now going to say our interest that we have calculated is 273. So we're coming here and we're going to subtract the 273 because it is going to decrease our net profit. So we come here, then we say minus 273. It will decrease the net profit. Okay, I know there was another quicker way of doing this adjustment, several other ways. And we're saying, but Mr. Simbi, why do the ledger account? I just wanted to go back to grade 10. Are we good? All right, can I move on then? Okay, I'm going to move on. And the next adjustment, all right, so before I do this one, I'm going to do this later. So what I need you to keep in mind, that 420,000, you remember that 420,000 that we're paying in total, and the 273, which is interest. We're going to do this in the next adjustment, which relates to the statement of financial position. All right, so we're not going to do it as yet. We're just going to park it. You see when we're doing it. All right, let's go. It says rent of 74,000. Very important. Rent of 74,000 was received from a tenant on the 1st of July. All right. Remember, when is your financial year ending? 30 June. The financial year is ending on 30 June. So rent was received from a tenant for the period 1st of July to 31 August. Okay. What do we see here? We see that if our financial period begins on the 1st of July 2020, it should end on the 30th of June 2021. But here we are being told about the 31st of August. So if we have the 31st of August, that means we now have income that was received in advance. Okay, rent was received. So this is income received in advance. It was received till August. So here is 12 months. Are you still there? And July, August. That gives us 2 months. So in total, we are dealing with how many months? 14 months. Should I continue? All right. We are then told this amount takes into account a reduction of 750 per month. So this one is after rent has been decreased by 750 per month from the 1st of May. From the 1st of May. So from the 1st of May, rent was decreased. So if it was decreased from the 1st of May, how many months was it decreased for? It's going to be May, because it's the 1st. May, June, July, August, because we received until August. 4 months. 750 times 4. Calculators, please. Calculators. How much do we get? Thank you. We get 3,000 rands. So we then say, this 74,000, this is after it had decreased. So it's going to be 74,000. Remember, it is after it has decreased. So we're going to add plus the 3,000. How much do we then get? We get the 77,000. 77,000 is the rent before it decreases. For how many months did we receive it for? 14 months. How much is rent per month before decrease? Please say 77,000 rather, divided by 14 months. So you get 5,500. Then you take that 5.5, then you subtract the decrease per month. How much is the decrease per month? 750. How much is it per month after decrease? It's going to be your, how much? You're saying 5.5 minus 750. 4,000, say it again. 4,750. 4,750. For how many months did we receive in advance? For 2 months times 2. Then that gives you 9,500. What is this? Income received in advance. We are doing the correct net profit, and then we're going to take it also to the balance sheet. Let's see. It simply means when we recorded our rent income, we recorded more of the rent income. More income was recorded. That means our net profit was also more. We overstated our profits because our income was recorded more. Our rent income was recorded for 14 months. That means our profit was more. We recorded rent for 14 months. Our rent was more. So what do we do now? We need to bring our profit down. So we come and we subtract those 2 months. 9,500. There it is. So you subtract it. Even though it is income, it is because we had put in the 2 extra months for the next year. So we must take them out. In other words, our profit has been inflated. We need to bring it down. But we know we are preparing a statement of financial position. Once we receive income in advance, it becomes payable. So I'm going to come here. Then I'm going to say plus 9,500. Plus 9,500. Are we good? All right. Thank you. All right. Let's see if we still have more adjustments. Here's another adjustment. All right. I think this will be the last adjustment here. It reads, after taking into account the corrections above, it was determined that an additional 85,250 is still owed to SARS in respect of income tax for the year. So we still owe 85,250 in respect of income tax. So that means when we come here now and we want to record our SARS income tax, all right, our SARS income tax, we will now say, have we made some provisional payments? Have we been making payments during the year? Provisional payments. Have we been making payments during the year? Yes, 1.2 million. So I'll come here, then I have my 1.2 million. Then, are we still owing SARS even though we have been paying? Yes, we're still owing SARS. How much do we still owe? 85,250 plus 85,250. What does that mean? How much should be the income tax for the year? 1.2 plus 85,250, 1,285,250. We good? Are we owing? Yes. Once we are owing, you have to remember, we must go to the what now? Statement of financial position, current liabilities. What do we then say? SARS income tax. Remember, SARS income tax. How much are we owing? 85,250. It's a liability. We are still owing liability. So the examiner has to bring these adjustments, and you must be able to do these 2 things at the same time. That is the only way you can finish. Are we together? All right. Can we go on? We're going to continue. So we are done with the calculation of correct net profit, but we are still busy with the statement of financial position. So let's go with the statement of financial position. It reads, debtors with credit balances totaling 11,000 must be transferred to the creditor's ledger. This is one common adjustment that comes, especially with the statement of financial position. Okay, debtors with credit balances. So we're going to do exactly as they're telling us. So we're going to come here, we're going to open a ledger account. Here's the debtors ledger. Debtor is an asset, correct? So it means on the debit side it's going to be a plus, on the credit side it's a minus. Are we good? Then it is going to be transferred to the creditors ledger. So we're going to open a creditors ledger, liability. So credit plus debit minus. Are we okay? Okay, let's go. Then we are told debtors with credit balances. So we're going to come here. We have a balance of 11,000. Must be transferred. So we're going to transfer it. Transfer simply means let's take it out of the debtors ledger. So we want to remain with 0. So if we have a minus 11,000, we have a minus 11,000, but we want to remain with 0. What do? We come, we say plus 11,000. We simply bring it to the debit side. So we're coming here, then we're going to say 11,000. That now equals to 0. But to complete our entry, we're going to come here, and then we're going to say 11,000 as well. Are you still with me? So what have we done? We've gone to the debtors ledger and we have said plus 11,000. That means we're coming to our trade and other receivables. Then we say plus 11,000. Can I go on? Then we also come to our current liabilities, trade and other payables. Then we still say again plus 11,000. Are we good? But the examiner can bring it as a debit balance in the debtors ledger. A debit balance in the debtors ledger must be transferred to the creditors ledger. That can happen as well. Okay, so you simply do the opposite. In other words, you're taking it to the minus, and in the creditors ledger, you can also put it on the minus. Okay, so please work with such adjustments. Let's move on. Can we do so? All right, thank you. Let's move on. All right, it reads, that is the next adjustment now. It reads, on 30 June, Jimo Limited, that is us. So these are points that you must pick when you're reading. Once you see Jimo, you think it's us. We returned 10 ladies' coats to the supplier. Once you read it like that, it will make sense. We have returned 10 ladies' coats to the supplier. Bargain wholesalers, the selling price was 1,750 each. Very important. Each per coat. Per coat. And how many were they? 10 coats. Very important. The markup was 25% on cost. No entry has been made. Can we go? All right. So we need to record this in our statement of financial position. Once we return stock, we need to record. The question is, do we record it at the selling price or at cost? We're dealing with what here? A supplier. Once we're dealing with a supplier, it must always be at cost. So that means we're going to say again, remember cost is what? 100. Markup is 25. You know where I'm going. So selling price becomes how much? 125. Are we together? Then the selling price is what? 1,750. You see where I am now? What do we want? Whenever we are dealing with a supplier, we record it what? At cost. So we want 100. What do we have? 125. Multiply this by 1,750. Calculators, calculators, calculators. How much do we get? Thank you. 1,400. But here's the key. This is per coat. And how many coats did we return? 10. You multiply this by 10 now. 1,400, multiply that by 10. Then you end up with 14,000. If we returned stock to the value of 14,000, how does that affect our inventory? Our inventory is going to decrease. So I'm going to come here, then I'm going to say minus 14,000. Because we've returned inventory back to the supplier. Once I return inventory back to the supplier, do I still owe that supplier? No. So it means I come to my trade and other payables, then I say minus 14,000 again. We good? because we've returned inventory back to the supplier. Okay, so at times the examiner can bring it like a debtor has returned goods to us, then we return it back to the supplier again. And then remember, it will affect the first 4 accounts, and then there's 2 accounts. I'm going to move on now. Okay, let's go. It reads, a fixed monthly installment of 35,000. This looks familiar. Does it look familiar? Of course it does look familiar. It is that loan adjustment. Remember we said we're going to park it. Now is the time. All right. Do you remember the amounts that I said you must keep in your mind? What were those amounts? It was the 35,000 times 12. And how much was it? 420,000. You still have those ones in mind. Okay. What else did I say you must keep in mind? The interest. I said you must keep the interest. How much was the interest? 273. Was it 273? Yes, the interest was 273. Okay, I said you must keep those in mind. Let's see. We are now told that the fixed monthly installments of 35,000 to cover the loan, that is 35,000 to cover the loan, 420, had to be paid over the full period of the loan. Interest will decline over the life of the loan. Okay, things are changing here now. The interest is going to decline. The interest on the loan is budgeted to be 234 in the next financial year. Okay, let's see what we must do. Initially, remember, we had this 3,755,000, remember, from the loan statement. And we're told that interest was not capitalized. You remember that loan that was not capitalized? Interest that was not capitalized, the 273. Then we added it. Or you could have simply taken that 4,028,000. There was a 4,028,000 that was also there. The 4,028,000. Okay? That was the balance at the end. Because if you add this and that, it still gives you the 4,028,000 in any case. Okay. So here we have the 3,755,000, then we capitalize interest. Okay, or you can just start with the 4,028,000, which was given in the statement. We are then told that we are making fixed monthly installments. Fixed monthly installments. Fixed. So if we're making fixed monthly installments, it's not going to change. It's going to be 420. The 420 is going to remain being the 420. It's fixed. And we agreed that in the 420, there's 2 things being paid. 1 is interest. 2 is loan. We are being told that the interest on the loan for the next financial year is going to be 234. That means here our interest is now 234. How much is the loan, therefore? Because what we want is the loan. We know how much interest is going to be, and we know we are making fixed monthly installments. So the amount that we now need is the loan. So you're saying 420 minus 234. How much do you get? You have a calculator. Let's say it again. 420 minus 234. How much do you get? Thank you. You get 186,000. 186,000. What is that? That is the loan we're going to pay when? In the next financial year. So here they were trying to tell us about the short-term loan, but they don't say provide for the short-term loan. They will just talk about the next financial year, and they assume you already know that once we're making fixed monthly repayments, we're going to pay for the next financial year. And if we're going to pay for the next financial year, there has to be a short-term loan that we have to put into consideration. So in this case, we're going to come here, then we're going to say minus how much? 186,000. And then that 186,000 is the current portion of loan, which we're going to bring here now as 186,000. Are we good? All right. So I've seen in other papers, they either tell you that it's going to decrease, it's going to come to this one, or they say it's going to decrease maybe by 20%. I've seen a paper like that where they say the interest is going to decrease by 20%. Or they say the capital portion of the loan, that is the short-term loan, or the loan that we paid last year, if we're to get the loan for the next financial year, it's going to decrease by 40% or 70%. So just be watchful of that. I've seen where they can talk about a decrease in the loan for the next year, okay, or an increase. Either way, you should be able to get these figures. Are we good? All right, let's move on. Let's move on. We are slightly behind time now. All right. Then, in this statement of financial position, we're given financial indicators. Once you see financial indicators at the bottom of the question, it simply means you must use those financial indicators to complete the statement of financial position. And as you can see here, we were given the acid test ratio. Do we know the formula for the acid test ratio? I think we do. What is the formula? It is your current assets minus what? Stock as to current liabilities. Oh, so that simply means if I am to use this information, I would need to have my my current assets, and then I would also need to have your current liabilities. All right, it's not going to be a problem. So here on my current assets, this is not mortgage loan. Okay, let's just fix that. That one has to be inventories. Okay, so here we have inventories here. That is your trading stock. Remember, we've done a couple of adjustments on it. Okay, and then the final inventory amount is 4,860,000. 4,860,000. That is the inventories. So we are coming to our current assets, which is how much? 8.7 million. So we have 8.7 million here. Then we subtract inventory. Do you see the inventory there? So we subtract the 4,860,000, and we say as to our current liabilities. The answer, therefore, let's solve this one first before we go any further. Do you have your calculator? Let's go again. 8,700,000. Okay, let's just go back. 8,700,000 minus 4,860,000. If we punch that in the calculator, we should get 3,840,000. 3,840,000. Can I go on? All right. So once we have the 3,840,000, that is as to your current liabilities. The answer, therefore, should be 1.2 as to 1. Okay, I know now you already know what to do. Some call it cross multiply. So you multiply that by that, you multiply that by that. So you're going to end up with 3,840,000 as to 1.2 your current liabilities. You want to remain with current liabilities. So you divide everything by what? 1.2. Divide that by 1.2. Are you still with me? And then how much do you get in a calculator? Thank you. 3,200,000. So that becomes now your current liabilities. So you're coming to your current liabilities and you're saying, I know how I got this. I said 3,840,000 and I divided it by 1.2. That is how I got my 3.2 million. But the examiner, once he gives you such a thing, they would want to get a missing amount. In this case, it was the bank overdraft. So you were supposed to get the bank overdraft. Okay, so once you get your financial indicators, there will be some missing amounts that you then calculate as balancing figures. So you then say your 3,200,000 minus the 1,259,500 minus 1,170,000 minus 186 minus 85,250. Was I too fast? Okay, my apologies. So you simply say your 3.2 million minus all of these ones here. How much do you then get? Okay, that will give you your bank overdraft. Can I go on? I'm going to go on. All right. In the next part, remember, we were given the net asset, value per share, the NAV. We're given the NAV. And once we're given the NAV, we want to get this section complete. Remember, what is the formula for the NAV? It is your shareholders' equity divided by the number of shares multiplied by 100/1. Remember, your answer must be in cents. So it simply means if I have the NAV here, then I know the number of shares that I'm having. I can get my shareholders' equity. I know I have 1.8 million shares in issue. So I come here on my shareholders' equity, then I'm going to open bracket. And then I'm going to say 1.8 million. And then I'm going to multiply this by 5.4. It's easier if you multiply by 5.4. If you convert it to rands already. Remember, it's 540 cents. But if you say divide by 100, it gives you 5 rand 40. And then it won't give you those huge amounts. And then you end up now with your 9,720,000. You can then get your ordinary share capital. How do you get that now? You simply say your 9,720,000 minus your 3,240,000. And this should give you your 6,480,000. Are we good? All right. So once you see these financial indicators, you should know where to use them. You should know where to use them. In this case, we're the asset test ratio and the NAV. The current ratio can still be used in the statement of financial position. Okay, I'm going to move on. Can we go on? All right. So in the very same paper, we're going to start activity 3. And activity 3 is on the cash flow statement. Let's begin the cash flow statement. The first thing we're going to do, we're going to calculate tax paid. All right. This is now the cash flow statement. All right. So I'm going to show you 2 ways of doing this. The first way is the T account, where we're going to open a tax account here. Then we're saying, in the year 2020, what was the balance? The balance was credit. So you had a BD here, which is 35,900. Okay. And in the following year, you had a debit balance. That means it's a BD here, 29,100. That means it was a CD here. That is your 29,100. And to get your income tax, you get the difference between net profit before tax and your net profit after tax. Do you have a calculator? Let's get the difference between 1,350,000 and then 985,500. It will be 364,500. 364,500. Then here you simply get your tax paid. All right. How much is that going to be? 429,500. This is one of the ways. The second way is to come here and you simply say tax paid. Then you open your bracket and you're saying 35.9. This was owed to SARS, therefore we paid it, plus the income tax for the year, which is 364.5. And at the end of the year, SARS owes us. That means we've paid more. So you say plus 29.1. Remember, brackets indicate cash outflow. And how much is this? For 29,500. Remember to do your note to the cash flow statement. Your note to the cash flow statement. Please remember to practice your note to the cash flow statement. All right, let's go on. The next aspect is your shareholders for dividends. We are now calculating dividends paid. Remember, we're in the cash flow on cash flow from operating activities. So we're going to say now dividends paid. All right. So I know before I even do anything, it's an outflow. All right. So with dividends paid, you know, this one is easy. What do we say? Last year's final plus this year's interim. How much was last year's final? Shareholders for dividends. Last year's final, 115,300 plus an interim dividend. This was a nice paper. All right. So you end up with how much? 277,300. Are we good? Let's move on to the next aspect. So this is your dividends paid. In the next aspect, we are now going to do the cash flow from financing activities, but we would want to do your note number 7 at the same time, your ordinary share capital note at the same time. Okay, so we're going to do that at the same time. Okay, but remember, we would want to calculate the amounts, that is proceeds from issue of shares. Would want to get proceeds from issue of shares. Okay, proceeds from issue of shares, as well as the what? The repurchase, as well as the repurchase of shares. We already know once it's a repurchase of shares, it's a cash outflow. So let's complete this note as we go about it. In the answer book, you had 800,000 given, and then we have 100,000 new shares that were issued. But in the ordinary share capital amounts, we're given 6.4 million already here. So the balance at the beginning would be your 6.4 million. All right, that is your balance at the beginning. The balance at the end, we have it in already. Then 100,000 shares were issued. There it is. We don't know how much, so we can't get that amount there. Then we are told 30,000 shares repurchased. Once I hear the word repurchase, I already put in my brackets. Then I come in, I can put the figures, not a problem. 30,000 shares are repurchased at 120 more. I know now, you see the yellow triangle. I know at the top, this is the purchase price, the one that goes to the cash flow. Here, I'm going to bring the average price that goes to note number 7. All right. And then here, I'm going to record the more, others call it the above, others call it the difference that goes to note number 8. All right. So we are told we paid more or above 120, above the average share price. So 30,000 shares were repurchased. Then we don't know how many shares are in issue. Then we can get those shares in issue, not a problem. We simply say 800,000 plus 100,000. You're still there. Now we have 900 minus 30. How much do we get? 870,000. 870,000 over there. Okay, so now that we have the 870, I think we can get this one now. Because if we take this 7 million, if we take that 7 million, which is your 7,395,000, we divide it by the number of shares, which is 870,000. It will give us average price. How much do you get on a calculator? 8 Rand 50. So I'm coming here to say my average price is 8 Rand 50. So I can come here and say the shares were repurchased at 8 Rand 50. The shares were repurchased at 8 Rand 50. So I can say 30,000 multiplied by 8 Rand 50. That's going to give you 255,000. 255,000. I can then get this one now. Do you have your calculators? I want to show you. You've heard about flipping the signs, isn't it? Or doing the opposite. We're going to do that one now. Can we start? It's 7,395,000 plus 255,000 minus 6.4 million. We get? How much does it give you? 1,250,000. So this is the amount we received from issuing 100,000 shares. So I can come and say the proceeds from issue of shares is 1,250,000, which is that amount there that we've just calculated. And then on the repurchase of shares, the easiest way would have been to say 8 Rand 50 plus 1 Rand 20. That gives you what? 9 Rand 70. Then we say, how many shares did we buy back? 30,000. 30,000 multiplied by 9 Rand 70. How much do we get? And then you end up with 291,000. All right. I was trying to show you the relationship between note 7 and your cash flow statement. All right. So please watch out for that. When you do your note 7, already think cash flow statement in mind. Can we go? Let's go. Then the next part, remember, we're still on our financing activities. Remember, on financing activities, two things. It's shares and loans. So here we can see there's a decrease in loan here. There's a decrease from 2020 to 2021. Watch out for these years tomorrow, please. So that simply means here we have a repayment of loan. So we come here, it is repayment of loan. How much were we having? It was 2.2 million, but we are left with 1,650,000. What does that mean? It means we have repaid. How much do you see, guys, on your calculators? I need those calculators active. Thank you. 550,000. Do you get 550 as well? Thank you. Thank you. So we all get 550. That is the repayment of loan. What if it had increased? What if here it was 2.2 and now here it's 3.2? What would that mean? It means the loan has increased. Why would the loan increase? We have received money from the bank. Cash inflow. Proceeds from loan. Okay, we can say cash from the loan. No bracket, cash inflow. No bracket, cash inflow. All right, so we've come to the end of this activity. We're going to do the very last activity, which is from activity number 4, which is from the June 2022. Activity number 4, which is from June 2022. So you get this activity from your ASC, June June 2022. Okay, so you get this from your June 2022 paper. I just wanted to touch tangible assets before I can say goodbye. Do you mind if I do so? Okay, so I can continue. Thank you. Let's do a bit of depreciation. Okay, we can't end the day without doing a bit of depreciation. Let's see if we can do 1 or 2 calculations on depreciation. So on your AC, that is your June exam paper for the year 2022, they had this interesting question, and we are going to calculate number 1, number 2, and number 3. Ready? Let's go. Number 1. So to get number 1, you're simply saying your cost minus your accumulated depreciation. Okay, I'm going to need calculators there. So you're going to say your 2,350,000 minus your 840. So you are writing this. You want the person marking your paper to know you know what you are doing. How much does it give you? Say it again. 1,510,000. Thank you. Can you go to number 2? Yes, number 2. We are calculating what here now? Depreciation. Okay, it's about to get exciting now. Let's hear what the information says. We are calculating on equipment. Equipment is depreciated at 10% per annum on cost. Now, in my mind, I have been taught that the moment I see the cost price method, I must begin to think, am I being tested on the 1 Rand residual value principle? It could be, because they can only test me on the 1 Rand residual principle on the cost price method. Okay, let's see. So I'm going to say, because here I have additions. Remember, additions is the what? Is the new. So that means I'm going to calculate for my old and new. Remember the son, sold, old, new. But in this case, I'm just going to calculate for my old, then I'm going to do my new. Let's start with the old. What is the cost price of the old? 640,000. What method am I using? 10% per annum on cost. 10 over 100 times 12 over 12. Okay, let's hear those calculators being punched. How much do you get? Thank you so much. You get 64,000. Okay, what is wrong with this answer? Yes, you are right. Because our carrying value is 28,000. So if our carrying value is 28, we cannot lose 64 then. So it means I was right. The moment I see the cost price method, I must begin to think, am I being tested on the 1 Rand residual value? Was I being tested? Yes. How do I know? When my depreciation is more than my carrying value, when my depreciation that I've calculated is more than my carrying value, Mr. Simbi, what do I do then? That means this is no longer my depreciation. I come to my carrying value. Then I say 28,000 minus 1. Then I will remain with how much? 27,999. This is only because it was one piece of equipment. What if they told us that the business had 2 pieces of equipment bought on the same day with the same cost price? That means I would have to subtract what? 2. If there were 3, 3. If there were 4, you know. All right, let's go back. So this is my depreciation. Let's come now. So this is the old. Let's come to the new. How much is the cost price of my new? 195,000. Okay, multiply by 10 over 100. When did we buy this new? Okay, they said an old vehicle was sold. All right, and then vehicles are depreciated. Additional equipment, there it is. Additional equipment was purchased on the 1st of October. So we're counting from October. Are you still with me? So if we're counting from October to the date of the end of the financial year. Because we're behind time, now you're going to get how many months? 5 over 12. So you're going to get 5 over 12. How much is that going to be? 8,125. All right, so I now have 2 depreciation amounts. I now get the total. So I'm going to say 27,999 plus 8,125. How much does that give me? Thank you. It gives me 36,124. 36,124. That becomes my depreciation. What was I being tested on here? The 1 rand residual value. What were the clues that the examiner gave me? Number 1, the cost price method. Number 2, when your carrying book value is lesser than your depreciation that you've calculated. Can I go to number 3? Let's go. Number 3, it is disposal at carrying value. We are told an old vehicle was sold at carrying value, on 30 November. The cost price of this vehicle was 252. So that means I'm going to come here. The cost price was 252,000. And its accumulated depreciation was 172 minus 172,000. Okay, but I think you've seen the recent way that examiners are testing now. They may not give you the cost, and they may not give you the what? The accumulated depreciation. They just give you the carrying value already, which is your 80,000. So they can say a vehicle was sold, all right, and that vehicle had a carrying value of 80,000 at the beginning of the year. And then, which method of depreciation are you using? We're using 20% on the carrying value. So it simply means you take that carrying value that would have been given. So I just explained 2 ways. In this case, we're given the cost and the accumulated, but the examiners can also just give you the carrying value. If we're given the carrying value, don't cry. They're simply saying we have already considered the cost and the accumulated depreciation for you. So they give you the carrying value. So you just start with your 80,000 here. Then you're going to say multiplied by 20 over 100. Multiply by how many months? All right. It was sold. Okay. The sale on 30 November. All right. That means we had the asset for how many months? 9 over 12. And then how much is that going to give me? It's going to give me 12,000. That is depreciation for this year. That is depreciation for this year. It's inside there. It's inside there. But I know that my asset had a carrying value of 80,000. Now it has lost 12,000 due to use. What is its carrying value on the date of disposal? It's now 68,000. So I'll come here, and my number 3 is 68,000. That is the disposal at carrying value. Disposal at carrying value simply means what is the carrying value of the asset that you have sold on the date of disposal. All right. Now let's continue. You need to keep some of the figures that we calculated. Remember, here they are. And then we now need to see what can we record in the cash flow statement. So what we're going to do, because we are way behind time, I'm just going to open a fixed asset at carrying value. Fixed asset at carrying value here. All right. So an asset, remember, balance brought down 7,988,000. And we're going to close off. Here's another balance brought down here. Balance brought down 8,746,500. That means here it's carried down 8,746,500. And then you bring in your depreciation. This is that total there. So if you add that total, it's going to give you 334,124. 334,124. And then you bring in your disposal at carrying value, the 68,000. It should give you the additional equipment that was purchased as well as the additions to the building, because we're not given the rent values. So we had to open this note. Okay. And then, all right. And then you come here. So the fixed assets purchased, if you close this ledger account, you will get your, if you close it up, you get your amount that was purchased on the fixed asset, which is your 1,160,624. And the proceeds from sale So this is in brackets, and the proceeds from sale is the 68,000 there. The 68,000, which is your cash inflow. But remember, you could have done this thing as a note as well, where you have your carrying value at the beginning, which is your 7,988,000. Then you say plus additions at cost, but you don't know that one. Then you say minus disposal, and your disposal was 68,000. Then you can also say minus depreciation, which is your 334,124, and then it will give you carrying value at the end, which is your 8,746,500. So you can still get this addition there when you do your calculation going up, flipping the signs. So this is an extract of note number 3, exactly what we have here, and this is just the ledger account. All right, so we have come to the end of today's class, but before I can say goodbye, I just want to touch quickly on this activity, which is from the NSC November 2021. So this one is an extract from the NSC November 2021. And in here, you are now looking at your financial indicators. It says the information relates to 2 companies. So you're going to find that when you are being tested on your financial indicators, you can be given 1 company or you can be given 2 companies. And then you are told the background information. Both companies operate in the fashion and clothing industry. The financial year ends, and then Bob Yates owns shares in both companies, and he has convinced the board of directors to repurchase 150,000 of his shares. He used the money received to purchase additional shares in Broom. Okay. Now, the first question, I'm just going to do 2 questions, then we're going to say goodbye now. 3.2.1, profitability. You have to know which indicators are from the profitability family. All right. And then it says, quote and explain 2 financial indicators to show which company is managing its expenses more efficiently and thereby being more profitable. I'm just going to do the answers with you. All right. So you're going to choose which company. And already here you can see that we have already chosen Broom Limited. That Broom Limited, its operating expense on sales has improved from 17% to 13.6%. All right, so that is by 20% or by 3.4 points. Okay, so that is the first part. The second part, what you could say, is your operating profit on sales. That is, it has increased from 20.5 to 24.2%. And then lastly, your net profit on sales is increased from 16% to 19.6%. All right. And then the last question that I'm going to do with you before I say goodbye, it is dividends, earnings, and returns. It says, comment on the dividend payout policy of Flexi Limited. Explain why this is an irresponsible change in policy. Okay, so we're commenting on Flexi. All right, let's go and do that. You see that the payout rate increased from, so remember, we're talking about Flexi. The payout rate increased from 59% to 115%. So it is increased by 94.9% or 56 points. In 2021, they paid dividends per share of 92 cents compared to the earnings per share of 80 cents. All right. And then, so in other words, they took 12 cents from retained income because their dividends are higher than their earnings. Although the earnings per share dropped from 138 to 80 cents, that is by 58 cents. The dividends per share was 10 cents more, the DPS here. It was 10 cents more than last year. And then last comment. The company, that is the company, is trying to keep shareholders happy, to appease the shareholders, trying to influence market prices by increasing dividends. The company is depleting retained income reserves, which can be more effectively used to rebuild the company. All right. So this is what I wanted to share before I can say goodbye. I know you guys have been practicing and you are going to continue practicing in the next few hours, but remember, you need to get a good night rest. You need to sharpen your pencils, make sure you have your calculators and the battery is kicking. And then tomorrow you wake up sharp and early and then you go to the exam center on time. Don't get there late. Get there on time. Make sure you visit your corporate governance and auditing as well. Prepare thoroughly for your theory questions. Know your formulas to the financial indicators. Guys, you have done so much already. It's only a few hours before you can go and make us proud. Remember, your results don't only affect you, it affects the entire team. We are all waiting for you to make us proud. Until we meet again in the preparation for paper 2, I wish you all the best for tomorrow because you have prepared adequately and nothing that is going to come in that paper is going to be impossible for you, for you are adequately prepared. I wish you all the best for tomorrow. Remember, 10 minutes reading time. Read everything nicely. And then remember to sharpen your pencils. See you tomorrow. It is goodbye and all the best.